Pitfalls of outsourcing opportunity and outsourcing. We've got Brent Bevan from MLC, Managed Accounts, Head of Investment Consulting. Kyle Lidbury, please welcome to the stage, Head of Research, Investment Research, Perpetual. And David Bainbridge, Head of Governance, Lifestyle Asset Management. Please, gentlemen, take a seat. And Toby, over to you.
Thanks very much, Mike. And it seems only a moment ago that I was up here. We're going to talk, one of the fundamental roles of advisors and advice practices is creating investment outcomes for clients, being able to transform a sort of relatively ill-expressed set of goals and constraints and objectives and family obligations and, that sort of thing into a coherent portfolio likely to achieve those goals. And the traditional model has been the licensee hands down a paper portfolio, the advisor gets on with it, and it's, look, here are 12 funds, let's meet again in a year, hope it goes well. That model is clearly not scalable and not demonstrably effective. And we're going to be hearing in the next session from Leah Schiaccia at ASIC about ASIC's view of the obligations that fall to advisors, licensees and trustees in being able to make credible undertakings to clients about the ways in which their investments will most likely meet their goals, objectives within their constraints and so on and so forth. So we've invited today 3 investment portfolio managers who come with very different approaches. So David, as Mike said, Chief Investment Officer of Lifestyle Asset Management, an investment arm of an advice business. Brent Bevan from MLC Asset Management, Head of Consulting for Asset Management, who brings, as you would all know, the depth of funds management experience that MLC bring to this. Kyle Lidbury, Head of Investment Research from Perpetual Private, who brings the high net worth trustee fiduciary approach to creating portfolios. And we're going to talk today in this session about the benefits and pitfalls for advisors of delegating more or less openly to an organisation like MLC, Perpetual Private, or in Lifestyle's case to David's team, the construction of investment portfolios. So I'm going to invite each of the 3 of them to give a few words about what they do. So David, starting with you. Yeah.
As Toby just mentioned, we're really the retail end of the market. Our group has about 25 advisors scattered around Australia, from South Australia up to Queensland, and we have within our group we have a company we set up which we half own. Which is Stonewall Capital, and Stonewall Capital runs MDAs, the standard 5 from defensive up to high growth, and we made the decision a couple of years ago to get a fairly high-powered investment committee so that we have a properly structured arrangement with those portfolios, and that's what we offer to our advisors. We don't make it compulsory. It's just, but we do say I'm actually head of governance within the group, and what we do say is that as advisors, they have to have a management strategy for portfolios. It's not a matter of just making an advice of a portfolio that looks good, is very appropriate at the time of advice, but then not having a way of managing it. So unless you have a proper management strategy for portfolios, we produced what we think is a good opportunity for advisors, which is the strategy used by all three here of having designated portfolios that will be managed by the investment manager.
Right.
And
thanks, David. Brent, talk about the MLC approach to portfolio construction and managed portfolios.
Yeah, very briefly. So there's probably three legs to this. Obviously, for those of you in the room who aren't completely familiar with MLC asset management.
Shame on you.
Shame on you, yeah, yes. We've only been around for 35 odd years. Not me, exactly, for MLC for 35 years, but MLC, 35-year heritage in the multi-asset space. That asset management business now encompasses what was the ANZ investment management and also the IWF investment management world. The multi-asset, multi-manager space is very much our heritage. Total funds under management, give or take 150 billion. So we're reasonably serious about it. And the majority of that, again, in that multi-asset space. In terms of our entrance into the managed account world, I wouldn't necessarily say we're a new entrant into that. MLC probably kicked off their first managed account 16 plus years ago in the direct equity space, through the Antares business. And we're a little later to the party in terms of the multi-asset world, but really that was just a recognition that, probably both the access and the cost and the technology around managed accounts had gotten to a level where we thought, it was appropriate to enter the industry. And really it was just about opening up our books to advisors and saying, this is just another investment vehicle that you can use to access the same institutional investment team, the same processes, and really leverage the same scale, that MLC has in this space for your benefit.
And we're going to come back to that issue of scale in a moment. Kyle, what about the Perpetual private approach?
Yeah, so Perpetual Private is the wealth division of Perpetual. If it was a dealer group, a standalone, it's about a $20 billion funds under advice group. It is the oldest part of Perpetual, dating back to the 1800s, so a little more than 35 years. We originally are a trustee, so Perpetual was formed as a trustee, and as such, that fiduciary duty, that unlimited liability in terms of acting in beneficiaries' interests, very much core to the culture and very much core to what we do. So investing our clients' assets has always been something that's been taken very seriously, and it's been, given birth to, some of the most successful asset management businesses in the country as well. We're a high net worth business when it comes to our clients, like individual clients. Our average client size would be about 3 to 5 million. So it's a little bit different in terms of the application. We've been running managed accounts since 2014, and we run, various implemented portfolios across a variety of different structures as well.
In fact, KKR liked it so much that they bought the shop, are buying the shop. So I want to pick up on this issue of culture that you just mentioned, Kyle, because it seems, as I observe the relationship between consultants or portfolio managers and advisors, that issue of cultural fit seems to me to be one of the key drivers. So Kyle, talk about how the culture in your portfolio management team is sort of relates to the advisors within Perpetual Private and other groups outside Perpetual Private.
Yeah. So again, sort of using that word fiduciary, whilst it's only relatively recently been introduced into the advice landscape, over various financial services reforms, the word fiduciary in a trust context has always been there. And as a trustee, it clearly means putting beneficiary or client interests before all others. So the culture around how we bring together portfolios is one of ensuring that we have a basis for all of our decision making across the process, and that there's an appropriate level of governance and oversight of what we do. So ensuring that the investment outcomes are what they are, but being able to actually understand the decision-making processes to how we got there, how we built that portfolio is extraordinarily important, because if it ever gets questioned, we need to be able to show that and demonstrate that, whether it's in court or whether it's with a regulator or otherwise. And so that culture, I guess, pervades what we've done from an investments perspective, ensuring that the research is very deep and very robust in terms of when we select fund managers, when we're calculating capital markets assumptions, when we're pulling together asset allocations, and when we're matching those asset allocations to clients, be they trusts, be it high net worth individuals, charitables, not-for-profits, or other structures.
And so, David, within Lifestyle, which is a dealer group for independent advisors, how do you think that the sort of cultural issues of the Lifestyle approach to portfolio management aligns to advisors? I mean, how do they form a view as to whether what you believe and the way you work is consistent with what they think and what they can communicate to clients?
Well, we've got to be careful about the use of the word independent, of course, but
Yes, we have somebody from Asset. We would never use that word other than in an informal sense.
It's interesting if you read the legislation. Part of the lack of or use of the word lack of independence is revolves around having a restricted APL, and we do have a restricted APL. However, we leave it up to our advisors to come up with any investments they would like to see. We put it through a screen and we explain to them why we've got other things already in there. Now, our approach is we try to get what you might call the best of breed, which is a bit difficult because the market keeps shifting the goalposts when you're comparing funds. Some funds are really well-performing funds at one stage and circumstances change and they're not. But so what we do is we just sit down with all of the advisors, we keep a dialogue going, and the main thing is that we talk to them about the fact that they are in the business of talking to clients and introducing new clients as much as possible wherever they can find those new clients. And the using managed accounts makes it so much simpler for them. We have been critical of some of the new advisors coming into our practice about having what I call lopsided portfolios, and I sit down and work through with them what they need to be doing with their portfolio structure, and they come to realise that having managed accounts makes life much simpler for them, and they can come up with much more predictable outcomes through managed accounts. And what we do is we just put the resources behind the scenes so that anything that we do has been very well researched. We've got 3 highly experienced analysts on our investment committee, and we don't do anything without them having thoroughly researched each of the applications for additions.
And Brent, the sort of the elephant in the room, well, as the largest portfolio manager in the room, how culturally do you align the sort of institutional nature of something like MLC asset management and all that goes with having responsibility for that much money with the fact that individual advisors run individual practices with individual clients? That sort of mesh between institutional capability and individual practice.
I mean, it's an interesting question. I think I might look at that at a slightly different angle, and I think David hit the nail on the head here, which he said is, what are you in the business of, right? And I think that's a pertinent question both for advisors but also in the managed account space. So the way I would view this is I say, what is MLC, asset management, in the business of? Investment management, right? What is the day-to-day activity of the team? Their portfolio managers, their asset allocators, their fund selectors. That's always been their core job. That doesn't matter whether it's the My Super product that we're running. It doesn't matter if that's a pension fund or in this case multi-asset portfolios. Having been someone who spent many, many years on the consulting side of the desk as well, what is your core focus day to day? And if you're an advisor and you're making the call to say, I want to outsource either part or all of my investment decision making, then who am I outsourcing it to? Am I outsourcing it to an investment manager who's going to be looking at that on a daily basis and that's their core job? Or is it another function, like in my world of consulting, where it's, we're building this, we're doing different solutions, I've got 100 different portfolios I'm looking at, 50 different clients I'm kind of, consulting to. So I think culturally, it's very important for advisors or practices or licensees to understand if you're going to partner with somebody to do this, and I'll use the word partnership because that's exactly what it is. It's this isn't dating, it's a marriage when you get involved in these things, and hence, getting it wrong and trying to unwind it is a very time-consuming and costly process. So you need to make sure that you're partnering with someone who you think you're culturally aligned with, whose investment process and philosophy you can get behind. You don't have to agree with every single part of it, but you can certainly align to it. And as someone that you can then trust to say, well, I understand that that's what you're doing on a day-to-day basis. Your business is fully committed to running money and being an asset manager because that's what you live and die by, and you don't have another, kind of 5 business lines that may or may not sustain you. And to me, I think that's the right set of criteria to set you up culturally, because any fund researcher will tell you culture is incredibly important to understand, but very hard to analyse. It's a very qualitative thing, right? So you've got to spend the time with your manager or consultant to understand, is that the right one that I think I can partner with, and are they going to align with me?
I must say, in my own experience of working with advisors and portfolio managers, yes, that so much of the decisions about who do we want to work with comes down to which people do we want to work with, which people do we feel will be appropriate for our approach. I thought, for those of you who weren't in Melbourne on Tuesday, one of our presenters, Ty Cockle from Financial Foundations, made a really excellent point, which was that when they had adopted managed accounts, what it meant was they could get to a position where everybody was doing the right thing in their practice. The advisors were advising, the administrators were administering, and the portfolio managers, and they had at that time, or still had internalised it in the way that Lifestyle do. The portfolio managers did that, and I thought that was really quite a neat way of thinking about the opportunity that managed accounts open up. So one of you mentioned the word scale previously, so I'd like to come back and visit that, the way in which as a portfolio management organisation you're able to bring scale to an advice practice. How does that work? What are the... Oh, well, it's least relevant perhaps to you, David. But,
well, I'm at the lower end of the scale. We've got the scale heading up that way. We measure our size in hundreds of millions, not billions. And what we also have to be conscious of is that the individual investments in the clients may have less than 100,000, up to maybe $1 million would be probably an upper limit for a lot of our clients. So the investments need to fit all that whole range. Now, we give a little bit more flexibility to our advisors by saying, well, what you can do is nominate a proportion, maybe 80% of the investment goes into our model, and then they have discretion on whatever remaining percentage. So that gives a bit more flexibility for our advisors as well.
What about, so Brent or Kyle, to what extent are you able to deploy, MLC or Perpetual's genuine scale in the interests of advisors and clients?
Yeah, well, I mean, scale there's a couple of different aspects to it, right? So scale, the obvious one is through a managed account. I can consolidate my best ideas. I can ensure that I'm bringing the benefits of scale, be that through rebates or a negotiated fee with asset managers to deliver a cheaper, more efficient solution, right? But there's also the aspect of scalability, right? We know that advice is costly and it's hard to scale. So removing obstacles to scalability is really important in terms of growing your business. The opportunity in managed accounts is absolutely there, right? So spending more time with clients, more time advising. We know that manager research is time consuming and costly and requires maybe a different set of skills. So being able to outsource that is the opportunity to make your business more scalable. But you also, like Brent was saying, to actually, there's lots of different benefits that you're getting. Being a scalable business means that you've got an automated portfolio management function, ability to roll out your ideas quickly and efficiently. I mean, does your client, if you're not using managed accounts, does your client understand that it could be up to 12 months between the time that an investment decision is made versus when that's reflected in that portfolio? And would they be happy with that? So scalability is becoming increasingly important. The technology is there, and I think if you're not running a scalable practice, that's not just limiting your own growth, but it's actually also opening yourself up to questions from your clients as well.
What about scale in an MLC context?
I think Kyle's probably nailed the main components there. I think there's just the different parts of scale. Obviously, what does a managed account program, SMA, MDA, whatever it may be, what does that bring at a licensee advice level? There's plenty of scale conversations there. How does an institutional asset manager like MLC bring scale to bear? That's reasonably obvious in terms of both access and pricing. Obviously, in the managed account world, a lot of talk about rebates. Most people should be able to achieve rebates on funds. A lot of the managers are moving more to various institutional share classes, just given the complexity and admin drama of rebates. If you're at the real top end of scale, then you can get to the point of saying, well, no, I actually want a fund manager to build a custom trust with custom pricing and features and mandates and then deploy that. But I think you need pretty reasonable scale, either your own scale as a licensee or you need to leverage someone like an MLC. Obviously, the pricing discussion we have with a manager when we're negotiating $1 billion mandate is very different than a $10 million managed account mandate. But we try to bring those two together in terms of our pricing. The other thing I'd say about scale too, I think that's also linked to a profitability kind of question as well, and it applies to everyone in the industry. It doesn't matter whether you're an asset manager or a platform. The mass consolidation we're having is occurring for a reason, because the hurdle to be scalable is growing ever higher. Once upon a time it was 50 billion for a super fund, now it's 100 billion, now it's probably 300 billion, right? To really be at scale. And the same is applying to asset management. Managed accounts is still in its infancy there, so there's a lot of players in the market who probably aren't anywhere near the scale that they need to be. And again, that's super important for licensees and practices who are thinking about this market, because if you're entering into a partnership and those individuals are now going to be running 60, 70, 80% of your FUM and your business is now intrinsically linked to their success, you need to make mighty sure that they have the scale and the robustness in their business to be there for the next 5 to 10 years like you are. So I think that's another aspect of scale that really needs to be considered.
Now, there's the opportunity, of course, for any of you to ask questions of any of our three panellists here. So if you do have questions, put your hand up, and we have microphones. Because we're streaming, please make sure you use the microphone. So are there any questions for any of our three panellists at this stage?
Or heckles. You can heckle, that's fine. We like that too.
Yes. Oh, one over here. Yes. Yep. Dan, I knew I could count on you. Yeah.
Probably directed to Brett. You made a comment about scale and funds management. Besides passive, do you have any real evidence that scale's worked in active management in Australia?
In terms of excess returns, I guess, or is it we're talking
returns is everything.
Yeah. Look, the active-passive debate, 10 minutes 56 on the screen.
No, it's not an active passive debate.
We could do
it's
it now.
Just have active managers. You say scale is important.
Yes.
Has it delivered in the active space?
I think for a fund manager, full stop, right? Whether you're passive or active, you need to have scale. Now, you can be at scale as a small boutique manager, like that's fine. No one said you necessarily need to be a BlackRock. Not every manager is going to have $1 trillion plus under management, but I think there's a threshold of which you go, if you want to be competitive, whether it be an active or passive, there are scale thresholds that you need to be at realistically in order to get the level of pricing, the level of service, because that's one. The price is one thing, but also, where's the service? Where's the governance? Are you working with someone who has the ability for ASIC to come out tomorrow with a new directive that all of a sudden requires millions of dollars of legal resources to be deployed to stay in business? Any licensee in the room can tell you what that feels like when that happens, and you need to make sure you have the resources to be there. So I don't think, or I'm certainly not saying that a manager that doesn't have 100 billion under management can't outperform. We invest in many, many small scale boutiques, and we've backed many of them over time. But it's a horses for courses of where you're playing it. I think in the multi-asset realm, then yes, you probably want to be dealing with someone that's got reasonable scale. Otherwise, you're just not going to get the pricing and the servicing that you're going to get out of other players, especially through time.
I think it's a really good question, right? Because there is so much focus on, if you look at the APRA test and the focus on super funds, the philosophy behind that is that scale is better, bigger is better, right? And scale does allow you to do a lot right? With more scale, more funds under management, you can afford to do more things, you can employ more resource, you can do more research. So there are benefits to scale, okay? Whether or not it produces the best investment outcomes, who knows? But scale, like if you think about private assets, for example, only large institutions historically have had the ability and scale to access these opportunities in inefficient and illiquid markets, which by theory should be able to generate an excess return more reliably than more efficient markets, right? Technology is the other end of that, and managed accounts is an example of a technology which has allowed institutional funds management to be actually implemented at an individual practice or client level, right? So managed accounts and separate accounts have been in the institutional space for decades. That's how they've been running. So instead of me running an institutional fund and investing in other funds, I actually hold those assets and run it as a managed account within my fund, and that's the whole premise behind multi-manager. Managed accounts is now allowing you to do that. You can run an Aussie equity portfolio at an individual level with the technology of managed accounts, and you're getting the cost benefit because there's no fund in there, there's less custodianship and there's less costs, right? So does it result in better investment outcomes? Not always, and we always know that. The promise of investment outcomes is uncertain. We sell hopes and dreams. But scale allows you to do a lot, and it does reduce costs. So there are aspects to it which absolutely is for the benefit of clients, and you can bring that benefit to your clients through that avenue.
Any other questions before we move on? Because the session's called the Pitfalls and Opportunities of Outsourcing Investment Management. So now what I want to do is touch on some of the things that you think are issues for advisors and the way they should deal with them. The problems that outsourcing the investment management process gives rise to.
Well, look, I think as a licensee, licensees have different responsibilities to the other groups that are here. I think that it's very good that ASIC are going to be represented here talking about outcomes, because there have been we acquired a number of advisors who came from old style groups and came in with very fixed ideas on portfolio management. We've had to change their thinking quite a lot. And the first thing, one of the big things is, so I'm getting away from this use of the word risk. If you look at RG 175, I think it's 319. They've got a list
There'll
of
be a
things.
test afterwards, by the way.
Yeah, there's a list of about a dozen things that advisors have to take into account when providing advice, and two of those mention the word risk. One of them is the risk of capital loss, their ability to, the client's ability to be prepared to accept some risk of capital loss, and the other one is the risk of the portfolio not achieving the outcomes. Now that to my way of thinking is where risk should be, but unfortunately a lot of situations risk is being defined by volatility, past historical volatility, which is not because volatility goes up and down. So it's nice to have the same kind of return with less volatility. No problem with that, but if you have very low volatility, you might not get that return. So there are there are different approaches that we've got to these kind of situations.
Yeah. So just touching on this question of the pitfalls for portfolio for advice firms. What are the things that you see advisors thinking about or struggling with?
I'll look very quickly. I think on balance, the outsourcing piece tends to be, the better outcome for most advisors, but not always. Look, what are the clear pitfalls in going down this piece, right? Firstly, what's your value proposition as an advisor, right? Number one. So before you're even thinking about, talking to a me of the world or a Kyle or anything, what's your value proposition as a firm and how do you operate? Frankly, if your value proposition is incredibly tied up in the decision making of investments, if you're out there saying, look, I'm the Bobby Axelrod of the firm, then a managed account is probably, it's just not going to work well for you, right? Because you're someone else is going to take that value proposition. And the first time a client asks, well, isn't this what I'm paying you for? Then any notion of rolling out a managed account is going to end, kind of pretty quickly. So the things we probably see is, and it's natural for us, right? Because it's the natural disposition for advisors. You jump straight into the solution mode of, what's the platform? Who are the managed account providers? There's 80 of these things on menu. Maybe I should talk to someone and build my own customer. That's kind of step 3 or 4 of the process, and that's where you see maybe a lot of time and energy spent on doing that. And then 6 months later, the managed account hasn't really rolled out, particularly if you're a multi-advisor firm, because it's one thing to have a principal, quite excited about it, but if the other 4 advisors aren't really committed and all they've really done is sit in the meeting and nod and say, oh, that sounds good, boss, yep, but they don't really like it, then the managed account rollout, you're not going to get that scale, you're not going to get that success, and you're going to have a bad taste in your mouth of that as a process.
And Kyle?
I think, again, pitfalls and opportunities, right? The opportunity on managed accounts, I think, is becoming really well known, right? Everyone's got Google, you can search it, you can see the benefits. There's a lot of data out there, increased time with clients, increased revenue per client, increased number of clients per advisor. Firms that have implemented managed accounts really well have achieved those benefits, but it's not just about outsourcing, and it's not just about, I see the opportunity, that's what I want. You've actually got to have a foundation of and an understanding of what your so again, value proposition, investment proposition. When a client comes in the door, what is your investment proposition to your client? What should they expect in terms of how you select investments, or how the managed account or the outsourced provider is doing that? And the other side of it is the advisor is the only part of the process that has a look through to the individual or the client. Right? They're the only part of the process that actually can interpret a reference portfolio or a model portfolio and actually translate that through to a client need and a client plan and build something that's appropriate for clients. That's never going to go away, whether you outsource the investment decision or not. And so your responsibility is always there. And we are going to hear from ASIC, and I think ASIC's going to be pretty clear that because you use an outsourced provider, as an advisor, that doesn't absolve you of the responsibility of the investment portfolio and whether it's appropriate for the client. And your consultant or your researcher doesn't have a view of the client, which is why it always comes back to the advisor. So it will become, and it is becoming, a more serious obligation as regulators have more scrutiny on our industry. And so understanding all aspects of that process, when you enter the partnership, you need to know a lot about your partner and how they go about things. And always think about, if I ever get questioned or if the client is dissatisfied, what is the basis as to why I've done what I've done with the client? And we should, we're all pretty good with that notion. But when you're outsourcing decisions, you need to understand, I've still got to have that comfort. I've still got to be able to, whether it's articulating to the client or giving clarity to the client, investment outcomes are what they are, right? And then the other question is relative to what, So I think we've had an environment where absolute returns have been fantastic this year, but when you look at relative returns, it's been really tough for active managers. So from a relative to composite benchmark, for example, not a lot of managers have outperformed. However, when it comes to absolute returns, most clients are really happy, because they've overachieved probably what their plan expected them to do. So all aspects of that, you need to be able to articulate that. You need to ensure that you're getting the communication, the information, the transparency from your consultant, and the consultant is building portfolios as to what you require, what your clients require. It's not just a simple, they can deal with the investments type decision.
So as we wrap up now, are there any final questions for Kyle, Brent, or David? Yep.
Let's make sure the next question's all the way over there, right?
Hi, it's Francie. I wanted to ask David a question. I think it was quite an important statement, actually, that you made at the beginning, that while you make and design your own portfolios, you don't force the advisor to use that. In fact, you've probably got a choice on that. And is there a risk that the industry is actually creating concentration risk with only selecting one outsourced provider and perhaps not using our buy menus or our signature menus enough, where there is quite a good selection of diverse managers in different sectors?
Yeah, well, the reason that we don't mandate, because I think that was a very bad practice among all of the big licensees leading up to recent times. And we like to have this independence, if you like. So that's why what we do is we give advisors, we actually do have, so we push, we don't have any rules, we just talk to advisors about where we think that they're under advising. So they might be giving a balanced recommendation instead of either a growth or a high growth, because if they've got a certain term, like 10 years or more, I don't think balanced makes sense at all. Certainly with a 30-year term on super, balanced is ridiculous in my view. So, and this is the risk thing, but then what we do is we give the advisors the option of nominating, as I mentioned before, they can just put a percentage of the portfolio into so there's a core that is managed separately, well-constructed, well-managed portfolios, and then they have their discretionary part of the investment, which they can invest in anything, so that they, as long as it makes sense to us, you know, it's on our APL and it makes sense. It's well researched and it makes sense.
Great.
Thank you.
All right. Look, thanks very much. Please join with me in thanking our three panellists.